People talk about the Federal Reserve as if it operates outside of time, outside of politics, outside of elections, outside of pressure. It's never been true, but right now, it's especially false. The Fed doesn't make decisions in a vacuum. It makes them inside a system where economic data, market expectations, and political reality all move at the same time. And when those forces start pulling in different directions, policy stops being a strategy and starts being a negotiation. That's where we are now. Over the last year and a half, the Fed has cut rates by roughly 175 basis points. Markets read that as a pivot, as a sign that the tightening cycle is over and normalization is underway. But that interpretation misses the context. Rates are still restrictive by historical standards. Inflation is still above target. Debt service costs are still compounding across households, corporations, and the federal government. Nothing about this setup resembles a clean easing cycle. These cuts weren't designed to restart growth. They were designed to relieve pressure. And pressure relief is what institutions do when something underneath the surface isn't behaving the way models expected. The key signal here wasn't the rate cut itself. It was the disagreement around it. Multiple dissents, publicly conflicting views, policymakers arguing not just about timing, but about direction. That almost never happens when the data is clear. When the economy sends a clean signal, central banks move together. When the signal is mixed, when inflation, employment, and financial conditions aren't lining up, consensus breaks down. That's exactly what's happening now. The labor market is the fulcrum. Payroll growth has slowed materially. Revisions have consistently pushed job gains lower. Even the Fed has acknowledged that initial employment prints are overstating strength and being revised down later. That matters because the Fed's true constraint isn't inflation optics, it's employment stability. Once the labor market starts to weaken, the Fed's tolerance for inflation tightens. Price stability becomes conditional. The mandate doesn't disappear, but the priority shifts. That's the pivot most people missed. The Fed didn't cut because inflation was beaten. It cut because the labor market started to crack. Now layer in the part most institutional commentary avoids saying out loud. This is happening in a political environment where interest rates are no longer a neutral technical variable. They're a visible economic lever, one that affects housing, equity markets, consumer confidence, and inevitably, political outcomes. Markets remember that. They remember a president who openly pressured the Fed, publicly criticized rate hikes, and treated monetary policy as an extension of economic messaging. Whether or not that pressure formally dictates decisions today isn't the point. The point is that the perception of pressure changes expectations. Once investors believe the Fed is operating under political constraint, even partially, they adjust behavior ahead of policy, not after it. That compresses the Fed's timeline. So now the Fed is trying to balance three things at once: a softening labor market, inflation that isn't fully extinguished, and a political backdrop that reduces the margin for hesitation. That's not a plan. That's a constraint set. And when policy is driven by constraints instead of conviction, stability becomes temporary by definition. In the next episode, we're going to talk about where that instability actually shows up, because it rarely appears where people are looking.